Okay. Title of Chapter 8 is Fraud Detection, Red Flags, and Targeted Risk Assessment. Ooh, good stuff. So let's see what they say about that, and we'll go on from there. Okay, I'm going to turn off my camera here, which for some reason seems to be very close this week. Sure you don't want to see a blown up picture of my face, so let's take that off. Okay, there we go. So let's talk about those red flags. Okay, not the type you get from using a dating app. These are the ones we get from fraud. All right. So, as researchers have found that experienced auditors' judgments about deception are less accurate for companies later linked to fraud, regulator investigation, or class action litigation. And this was, when this came out, this was quite the survey, because it was felt that, you know, experienced auditors, these folks, they would know if there was fraud going on. It turns out, maybe they're not all that accurate. And this could counter if they're first instructed to look for signs of guilt in the CEO's voice. So the idea was, let's train our auditors to listen to CEOs, and so, you know, especially when we're talking about financial statement fraud, and look for those cues that they might be lying to us. In which case, very experienced auditors have the capacity to discern when upper management is being deceptive. So good stuff. All right. So the 4 modules of this chapter briefly introduce the interface between corporate governance and fraud. Then we review the framework for detecting fraud and anomalous activities. Then we look at a close examination of a targeted risk assessment, and then take a look at targeted risk assessment in a digital environment. Okay. Whoa, look at that beautiful drawing. I remember as a child, there was a toy that you could use that could make these sort of circles and such, drawing in any event. So what are some of the risks out there that might indicate fraud? Well, they can come from any number of places. They can just be external, okay, outside your organization. Market manipulators they're exigent, okay, outside your control. Then, of course, extortion and bribery. The customers could be a problem too, okay, with regards to kickbacks, money laundering, and warranty and exchange fraud, and just outright theft. Your competitors could be colluding against you on prices. It could be stealing intellectual property. A lot of industrial espionage, and it doesn't have to do necessarily with foreign governments, though often they are involved. This could be your competitors. There, in one of my other courses, I talk about a case a couple of years ago of the secret formula for Coca-Cola, and only a few people have access to it. Well, one person got access to it, and then tried selling it to Pepsi, and Pepsi, to their to their credit, immediately called the FBI and was like, we're not doing this. So and the FBI set up a sting and caught the perpetrators. And it actually was the Coca-Cola formula. And then you've got, over on the right-hand side, you got fraud coming from your board members. Maybe they're involved with insider trading, conflicts of interest, stock option manipulation, illegal political contributions. You have suppliers, okay, purchasing kickbacks, overcharging, substitution of goods or services, and then employees. That's theft by employees, inappropriate promotions or bonuses, misappropriation of assets. That's stealing stuff. fraudulent time reporting, unauthorized expense reporting, identity theft, and then management. And there's all those things in there. Fraudulent reporting, revenue manipulation, expense manipulation, bribery, theft, asset overvaluations, liability undervaluations, tax evasion, stock option manipulation, conflicts of interest, money laundering, misappropriation of assets, improper labor practices, illegal political contributions, and just overriding the internal controls that should stop a lot of that stuff. So let's start by talking about corporate governance and fraud. It's one of the, if you say, good things that might have come out of the Enron scandal some 25 years ago was the idea that, fraud really is a responsibility of management. It's not a responsibility of auditors to find it or the customers or whatever. It's management. You should be on the lookout for it, okay? You should have a system set up with the proper policies, proper controls, etc. However, even if you do, there's the risk of management overriding those controls and colluding with outsiders. The role of the external auditor, again, SAS, Statement of Auditing Standard number 99, came out in the wake of Enron. And it says, hey, you folks, have been going for actually decades before then, not thinking about fraud so much. That's not good. And so now you have to consider it almost constantly during the course of an audit. Think about materiality. And if you have fraud, materiality is almost, you should think about material. If somebody actually had a case, I think I may have mentioned, where I was out on an audit as a junior auditor, and somebody came into the office, into my conference room where I was working, and said, I want to report somebody who's taking kickbacks. Woo. But she wouldn't tell me. She had to talk to a partner. So I got the partner to come out to the site, and it was, I think I may have mentioned, the purchasing person was over-purchased some copier toner, and as a result was given a rival crockpot. And I remember the partner looking at me at that point and was like, for this, you brought me out here. So materiality has its place. I think the partner first of all said it wasn't a bribe, that was a promotion, a promotional thing. And it wasn't like they bought 5 years worth of toner. They bought maybe a little bit more, but not much in any event. But the problem with applying materiality to fraud is fraud cases generally start, if there's fraud going on, you want to know about it, and nip it in the bud. And if it's, it may start out as a small number, but it will balloon. So you have to, think about that concept of materiality as it applies to fraud. Again, we have earnings management, which is okay. Earnings manipulation, though, is fraudulent. We also have our board of directors and audit committees who are supposed to be on top of this, working with your external auditors, and then internal auditors as well. If they're doing their job, they should be looking for fraud. But also if they're positioned appropriately within the organization. Okay, let's talk about management's responsibility. What are they expected to do? Well, usually what happens is suggested by management, the board will adopt certain objectives, strategic, operational, performance objectives, goals. Okay, and they're to meet that. They're to measure performance, communicate results. Statement on Auditing Standard number 1 says that management is responsible for adopting sound accounting policies, and for establishing and maintaining internal control. Okay, so don't look to the auditors for, adopting. I mean, it's not their job. Their management is who's really responsible for this. They're to provide fair representation in the financial statements and provide the information necessary for independent auditors to perform their audits. But, okay, even if they have on paper good accounting policies and procedures, what really is going on there? Okay. And especially if management overrides those controls. And then again, collusion as well. Internal controls cannot control management overrides. So you can have all the internal controls you want, but when the big boss comes in and says, give me a check for $10,000, make it out to this person and get it on my desk in 10 minutes. Well, you're probably going to do it. Likewise, if there's collusion going on, because we talk mostly about, separation of duties, and also, most transactions should be at arm's length. Well, if there's collusion, it kind of breaks that all down. Now, they also have to fear that they will be detected. So one of the good things about controls is that, and auditors, is there's a fear of detection. But if you override them and no one's reporting it, well, then not so much. 3 procedures to identify a breakdown in internal controls due to override and collusion. One is look through the journal entries, okay, recorded in the books and records. Are there just sort of out of the ordinary journal entries going on, out of the normal course of business that you would expect? Also, review significant accounting estimates. Things like depreciation, things like the collection on accounts receivable, warranty costs. Review those. Are those reasonable estimates, or are they estimates that have been manipulated so that the financials look good? And then those one-time transactions that get recorded in the book, those are the ones where sometimes just to force the numbers to make the financials look better, and they commit fraud in doing so. Okay, so what about this difference between collusive fraud and solo fraud? The leaders of a collusive fraud tend to be younger, male, and less likely to have college degrees than the solo offender. Okay, so these are young guys on the make, and let's get together, bros, and let's pull off a fraud. Solo fraudster, older, more experienced, knows the system, and doesn't need the collusion. He's able to pull it off himself, or she. Collusive fraud leaders are less likely to exhibit personal behavior issues, such as addiction problems or excessive control issues, in comparison to the solo offender. Collusive fraud leaders are more likely to exhibit unusually close association with vendors or customers and have a wheeler-dealer attitude. Oh, yeah. Okay. Collusive frauds are more likely to involve financial statement, have larger dollar losses, and are of shorter duration. Okay. But yeah, you've got a collusion going on. You're breaking down some of those controls, and those dollar losses can be significant. Collusive frauds are more likely to be discovered by tip or complaint, internal audit, law enforcement, or by accident than the solo fraud. Okay, so what's left to catch the solo fraud? Not much. Okay, differences between management override fraud and those involving a lack of controls. They just don't have the control in place. Okay, well, perpetrators of management override are more likely to be older, senior level, educated males with shorter tenure at the organization. And they came in just a while ago, but they're, swinging their power around and are ordering people to do things. Okay. These perpetrators are more likely to engage in corruption or financial statement fraud, less likely to commit material fraud. Management override is more common outside of the U.S. We're pretty good at staying on top of that. Organizations, but not completely. As I say, I've been involved in a couple of cases which involve just that. And it doesn't have to be the CEO. They can, as I say, I think I've seen more involving like CFOs than CEOs. The organization's anti-fraud environment is positively related to the likelihood of management override fraud. The lack of controls fraud setting is markedly different from override in important ways, suggesting a need for different remedies across those two different settings. So here comes the external auditor. So you're a CPA, you've been hired to audit a company. What's your role? Well, your whole thing is, again, management is responsible for coming up with the financial statements. Your job is to audit them and opine on them. And your standard is reasonable assurance, not complete assurance, not 100% assurance. That's just not possible. Reasonable assurance. That the financial statements do not have a material misstatement. Okay, so a lot of wiggle words there. So we're not saying that the financials are accurate. We're saying that we're going to give you reasonable assurance there are no material misstatements. We use analytical procedures, looking at the relationship between the various numbers. The expectations gap is what I mentioned before, is the idea that very often the users of financial statements, especially shareholders, don't understand the role of the external auditor. As I say, many folks think the auditors put the financial statements together. They do not. They audit them. And again, they don't say that they're going to be 100% accurate. Not even sure you can say that accounting, since there's so many estimates and such. Just that they're giving reasonable assurance as to material misstatements. But so there's this gap between that which the auditors can and do provide and that which the users expect. The external auditors also attest to the fairness of management's presentation of the financial information. So not just that the numbers are good, but also it's presented in a fair manner. And we talk about the various types of audit reports. We have 5 things listed there. Actually, only 4 are audit reports. The unqualified opinion, which is the good one. That's the clean opinion. It's a horrible name, though. So many lay people say unqualified opinion. What? They're not qualified to give an opinion? No. We're saying that we don't have any qualifications. You don't have any qualifications? No. It's the report. We're not, saying it's anything but good. How about that? But then we have the unqualified opinion, but that by itself isn't enough. So we're going to add an explanatory paragraph, or we're going to modify the wording of that standard unqualified opinion. Then we have the qualified opinion. Okay. Some people might think, oh, you're qualified. No, it's not a good thing, or it's not a terrible thing, but it's not a clean opinion. The disclaimer is not an opinion. You're disclaiming any opinion. You're saying, we couldn't make an opinion. For whatever reason, the client never gave us the material that we need in order to audit it appropriately. Maybe the records were destroyed in a fire, what have you. So a disclaimer is not an opinion. It's a report saying that we can't express an opinion. And then the very worst is that adverse opinion, where we're saying that, hey, these financial statements, oh man, they're horrible. Okay, they are misstating things in it. So again, very seldom do you see an adverse opinion, only because the consequences, especially to a publicly traded company, of an adverse opinion are, well, adverse. Your share prices, your stock prices are going to plummet if your auditors come out with an adverse opinion. So very, very seldom do you see one. And because if the auditors tell management, hey, unless you do this, that, and the other thing and change these numbers and make these adjustments, we're issuing an adverse opinion, that usually gets management to go, oh, okay, we'll do whatever you say. Okay. So in a sense, the auditors kind of carry a trump card that we can play if necessary. Then came the big Enron fraud, where you had this, Fortune, what was it, like top 10, top 20 company, Enron, suddenly declares bankruptcy because of fraud. That's not good. So a lot of stuff going on in Capitol Hill, brought us the Sarbanes-Oxley Act, and then in the AICPA issued the Statement of Auditing Standard number 99, and a few years later, number 113, titled The Consideration of Fraud in a Financial Statement Audit. And it emphasized, hey, auditors, we kind of got away from looking for fraud. I mean, historically, they did. It was more about, concerned about the definition of revenue and things like that. And they were looking at all this, looking at the numbers, but not looking for fraud. No, you've got to look for fraud. So, emphasizing or boost up your professional skepticism. Don't just accept everything the client tells you. Okay, they may be lying to you, maybe gaslighting you. So, again, at the beginning of a audit, before you really begin field work, you have the pre-audit fraud brainstorming session. I don't like calling it a pre-audit. It's really, part of the audit. It's like just at the very beginning of the audit. You get the whole audit team together. Everyone's going to be working on this audit, especially the ones who audited that company in previous years, and say, okay, where do you think we would find fraud in this organization? Who would be doing it? All right, you bring them together and come up with some ideas and brainstorm. You have interviews with management, talk to them. Sometimes just say, so, hey, who do you think would be committing fraud in this organization? And then you design your audit testing to put in some tests that deliberately are looking for fraud. Remember, a material misstatement of financial information can result from either fraud or error. Okay? And the difference is intent. Did they intend to misstate that? Or did they just transpose some numbers? Or left off the first or the last zero or two zeros or whatever, and just it could just been a clerical error, or it was meant to be fraud. So again, intent is the difference. So remember, fraud is an intentional misstatement, and it can be achieved through manipulation, falsification, or alteration of the underlying accounting data, records, and documentation. Likewise, it can be a misrepresentation or omission. Okay, so not saying something when you're supposed to say something and leaving it out of the financial statements is also fraud. So misrepresentation or omission of events, transactions, or other significant information. So come the end of the year, you're issuing your financial statements, and you forgot to mention in the notes that your largest manufacturing facility burned to the ground on New Year's Eve. Oops, left that out. Well, that would seem to be a deliberate manipulation. And then intentional misapplication of accounting principles. Okay, also fraudulent. All right. So 8 steps in considering the risk of fraud in an organization. Number 1, as I say, you have that brainstorming session. Okay, you bring everyone together and talk about it, and you discuss. And you say, okay, here are the possibilities that there's fraud going on. What would be, how would we identify it? So, write that down. And then, identify those risks. Assess the identified risks and the potential schemes after considering internal controls. Then, from that assessment, respond to the results of the risk assessment. Evaluate audit evidence. Communicate, mostly to your audit committee, about fraud, unless the audit committee is in on it. And then number 8, document everything. Why is that? Well, some would say, well, this is what's required as a good professional, blah, blah, blah. No, it's called, some of you might be familiar with the initials CYA, for cover your, what, okay? You might get sued. I mean, if there's a big fraud, they'll sue everyone. They'll sue the board, they'll sue the management, but they'll also sue the auditor. And you want to cover yourself so that if you do get named in that lawsuit, you've got this evidence saying, look, we went through all the required steps. See, here are our notes from our staff discussion where we brainstormed. Here's what we came up with. This is what we did. This is, all the way down to, and this is what we told the audit committee or the board of directors, etc. And so you're really documenting all that stuff, contemporaneously as it's happening, so that if something does blow up in your face, you have the documents to put on a good defense. Okay. Okay. So, okay, what are those things you document? Again, steps 1 through 7. Have someone, when you're having that brainstorming session, say, okay, who wants to write down the stuff? Fine. Or, as we can do now, just, have a microphone on and have some, good AI software that will, hear the different voices and create essentially a transcript. Now, you might want to have somebody take a look at it, because if you ever watched closed captioning on a TV show, sometimes what comes up isn't exactly what they're saying. It's not what they're saying. So, but have someone take notes so you can document that discussion, one, took place and what you talked about. Information that were used to identify risks of fraud. What did you find? The risks assessed after considering programs and internal control, the results of your assessment of fraud risk, and the evaluation of audit evidence, and then communication requirements. Again, if you're a publicly traded company, you have to, and even non-publicly traded, sit down with the audit committee. Well, you don't have to sit down. You can stand up and make a presentation to them, and or the full board, and communicate what you did and what you found. Now, what about this thing about materiality? All right, Financial Accounting Standards number 2, FASB number 2, statement SFAS, Statement of Financial Accounting Standards. Okay. Referred to as FASB 2, named for the organization, the Financial Accounting Standards Board, states that the magnitude of an omission or misstatement of accounting information that, this is what makes it material. It's information that, in light of the surrounding circumstances, makes it probable that the judgment of a reasonable person relying on that information would have been changed or influenced by the omission, or misstatement. Whew. So, you have to kind of put yourself in the shoes of an investor, or maybe a loan officer at a bank, and say, would that investor, buy shares in this company or sell shares in this company, change their mind on what they wanted to do if they knew about this misstatement or omission? Is that big enough? Okay. Or for that matter, that loan officer. If it's just a couple of bucks, probably wouldn't change their minds. But that's not a very easy standard, okay, to try to apply. But that is what we have to do. So as a result, materiality is a relative concept. A lot of it has to do with the facts and circumstances surrounding, so it's not just a dollar amount, though we often treat it like a dollar amount. It's also the circumstances around it. So if it's a $1,000 fraud being perpetrated or was perpetrated by a low-level employee who's no longer working for the company, okay, not a problem. $1,000 fraud perpetrated by the CEO right towards the end of the year, who's with the company still, and may have been just trying to test the waters. Okay, now that might be a little bit more material because of the facts and circumstances involved. And we see that illegal acts have no materiality threshold. So our Foreign Corrupt Practices Act tells us that any violation of FCPA can expose the client company to fines and penalties that those fines and penalties may be material. Therefore, the violation is material, regardless of size. Again, consider the qualitative versus the quantitative aspects. Okay, if it's involving a division of a company that's on the brink. So not just the dollar amount. Just don't get fixated on a particular dollar amount. Think about where it was taking place and what was going on. Statement of Accounting Standard number 111 limits the tolerable misstatement. So how much misstatement are we willing to tolerate? Okay. 111 puts limits on how much we're willing to let go. So how do we come up with that materiality idea? Okay. It's kind of subjective. So we consider judgment and expectations. We anticipate the potential readers of information. Who's going to be looking at these financials? Okay. So a public traded company where there's going to be millions of, investors potentially looking at it. Or was this a small company and the only one looking at it might be, the loan officer at a particular bank? And, would they care as much as those small investors? I don't know. You have to place yourself in that situation. Remember, the public expects the CPA to be the financial cop. They're not going to be there going over the accounting records, and even if they could, they don't know what they're looking at. So they expect the CPA to look at those accounting records and make a determination. So in the several decades past, there were accounting firms would say, okay, materiality level will be, 2% of revenue, or 5% of net income, or they just come up with some formula. Can't really do that. Okay, auditing standard number 5, comes into place here, and sometimes you have to look at minutia, because it's not just the dollar amount, it's the risk involved. The standard encourages us to be consistent with this, but again, this is a hard area because there is no hard and fast formula number to come up with. Okay, This always reminds me of a situation I had some years ago where a friend of mine was starting up her own company, and she was going to sell a product, and she said, "What's that formula for determining the price that I should charge?" I said, "Formula? Yeah, yeah. It's like I can figure out how much each unit costs, and then the price is, some percentage. It should be some percentage above my costs." I was like, "No, the price is what as we say, it's the price that you maximize your return. The lower the price, you might sell more units, but then you might not get as big a profit as you would by selling fewer units at a larger price." There's no hard and fast formula. Same with materiality. It's very subjective, and usually the partner in charge of the audit sits down with the next level managers of the audit, and they work this out, looking at the past history they've had with this client, looking at the factual situation going on with this company. Is it a company on the brink? Is it in an industry that's having problems? Or is it, very well established, making money consistently? A lot of these things have to come into consideration. All right. Earnings management and fraud. Okay. I think I may have mentioned before, I used to get these things in the mail for earnings management seminars that were somehow I got on the mailing list for this place. It was mostly sent to CFOs, okay, chief financial officers, controllers of corporations, and it was like a 1 week course that was conducted on a cruise ship in the Caribbean. And so on the days, may have been 2 weeks, but in the days when the ship would be traveling between islands, they would conduct the seminars. And then, when you get to the island, they take a break, you enjoy the island, and then you get back on board and you go to the next island. There's a seminar. And they would teach you the ways in which, under generally accepted accounting principles, you could massage earnings to get them to do what you want them. You want them to show a profit of no more than X percent, but no less than X percent. They could show you ways of doing it. Again, within the rules of accounting. All right, but, is that a fraud? If you go beyond that which is allowed under the rules. So rules do allow you some wiggle room, okay? And some estimates and things like that. But you have to be careful with this. So if you have deliberate actions by management to meet specific earning objectives for, private gain, such things as income smoothing is a specific type of earnings management whereby revenues or expenses are shifted between periods to minimize the naturally occurring year-to-year fluctuations in net income. Yeah, in net income, you charted it, it bounces up and down, or should. For some reason, Wall Street doesn't like that. They don't like that reality. They want to see a nice, smooth curve upward. So, staying within the rules of accounting, you can give them that. But, it's when you're going outside the rules of accounting that you have a problem. You have to establish for this a materiality threshold. Again, remember that accounting principles and policies do provide some degree of choice. And while income smoothing can be just the way of doing business, it can lead to fraud, okay? And if you think that's going on, you better look for that clear and convincing evidence. Not just that they're, massaging the income numbers, but that they're doing it fraudulently. What about our boards and our audit committees? All right. Remember, their primary responsibility, oversee management, direct the internal auditor, and direct the external auditor. That second one, again, yes, that's who the internal auditor should report to, the audit committee, or directly to the board if there's no audit committee. Um, I was brought in one place where after they had a big scandal involving the president, and he convinced the board that the internal auditor should only report to him. No, that's not good. Okay. Internal controls over financial reporting, the company's internal control process. Okay, the board and audit committee should be, assessing that, should be aware of that, should be establishing that. And assurance. Management has adequately assessed the risk of management override or collusion among top level managers and executives. So they got to be on top of it. Far too often, board members, and since I've mostly been on nonprofit boards where the board doesn't get paid, and if it's for a charity, very often they're expected to come up with money. They're not paying a lot of attention on this stuff, and that's unfortunate. But they should be assuring that that controls and such are in place so there will not be incidents of fraud. Additionally, they are responsible for establishing and invoking and pushing a positive tone at the top with regards to ethics and honesty. They should have anti-fraud programs going on within the organization. They should have established ethics training, establish a zero tolerance policy regarding fraud. Again, if you have a whistleblower or tip hotline, it should be reported either directly to members of that audit committee, or the audit committee designates someone, maybe even the outside auditors, to take in those tips and report them to the audit committee. And then also to protect the whistleblowers if they are not anonymous. Okay. Now, if you have watched, as you should have, the videos on Crazy Eddie Electronics, you'll see that one of the ways they were able to get away with what they did is my buddy Sam Antar worked for the auditing firm, or worked for the accounting firm that was their auditors, and then came out and he knew how they conducted the audit. And that firm basically, well, they conducted essentially off-the-shelf audits. They didn't, adjust them for the particular client. And so Sam knew exactly what they were going to do, knew exactly what they were going to be looking at, and set things up so they would only see what they wanted to see. So those packaged and process-oriented audits, fill in the blanks, check the boxes, that's not good. For the fraudster, it's great. If you can, if you do that, then you've essentially tipped me off as to exactly what you're going to be looking for, and I'll make sure that it looks exactly that way. Remember also that many audit committee members, many board members, and audit committee members are generally members of the board as well, receive compensation in the form of stock options. Unfortunately for me, I never have. Okay. And then again, audit committee members, board members, gosh, God bless them for what they do and all this, but they might not be prepared for dealing with financial statements and numbers and such. Maybe their background is in engineering. I mean, I've been on boards, for universities and colleges and hospitals and such. Well, members of the board are in a hospital, they're doctors, and they don't know what accounting. They don't know hardly anything about accounting except for maybe the QuickBooks that they use for their practice, and they probably don't even know that. Likewise, a college might have educators on there or not, and they don't know accounting. That's why Sarbanes-Oxley, originally they said there should be an accounting professor on every board. Would have been cool, but they changed that to just a financial expert. So hopefully they have at least one, good financial expert on their board. If you have internal auditors, they're good for a number of reasons. Right off the bat, is that increased perception that fraud perpetrators will be detected. Okay, that goes to deterrence, playing with people's heads. All right, so it's like, ugh, they just hired an internal auditor. We could get caught if we tried to do this. So that's good. They also audit operations, evaluating different segments of the company, product lines and division profitability. Also will make suggestions to improve internal productivity. Operations audits, they also are involved with financial reporting, evaluations of the firm's internal controls. Important, again, since Sarbanes-Oxley requires the CEOs and CFOs to sign off on their internal controls, they would like to have their internal auditors take a look and give them assurance that they're working okay. Internal auditors are members, or should be members, of the Institute of Internal Auditors, from which they can be credentialed as certified internal auditors, or CIAs, unfortunate letters, but if any of you would like to go in internal auditing, it's a great area. I know a number of folks who have either leaped right into it or became CPAs first, and then got hired at a company is in internal auditing, and it's a great career path. And the IIA issues its own statements of standards for internal auditing, and number 3 addresses, amongst other things, fraud. Okay, there was module 1. Let's move on to module 2, and let's detect that fraud. So when we talk about fraud examination, basically we're talking about fraud detection, fraud prevention, and fraud deterrence. Okay, fraud detection, basically fraud has taken place, and we're going to find it. We're going to find where it is, how much it was, and who did it, and how they did it. Better that you have good fraud prevention and deterrence, so you don't have it at all. So big part of an external audit is auditors. They get out there, do the drudge work of matching up documents, making sure the numbers match, see whether they have the appropriate support and it's adequate. See, is there before a bill got paid, was there a purchase order issued? Was there a receiving report received? Was there an invoice received? All the numbers match up, and then there was a check issued for that amount. Yay! Or a wire transfer. Cool. But that's not enough. The fraud examiner and the forensic accountant, they'll determine whether the documents are real or fraudulent, whether the expenditures make sense, and whether all aspects of documentation are in order. Okay, so sadly, too many auditors, whether internal or external, seem to have blinders on. They just want to get through the day, match up these documents, say everything's there, fine. The fraud examiner, the forensic accountant, wants to look at sort of a bigger picture. As it say, increasingly, fraud examiners and forensic accountants are using social media for looking for fraud detection. You might not be able to, for example, get into and see the credit reports and all your top people in the company and look at their financial statements and look at their personal financial statements, look at their bank accounts, etc. But there are things that we can see on social media, whether it be, uh, Facebook, Twitter, now X, what are the other ones? Blue Sky, Instagram, MySpace is gone now, I think so. Anyway, information you can collect from tweets, etc., can be used. We use predetermined keywords, just as fraud and bankruptcy. You can use data mining through unstructured text. And by the way, the last issue of the Journal of Accountancy, the official professional magazine of the AICPA, the American Institute of CPAs, had a whole story on use of AI in the conduct of audits. It can be very useful in the conduct of fraud examinations. Okay, so use data mining from unstructured texts. And from that, you can extract names, residence, locations, age. System then correlates the text data to a database of financial transaction databases of a large credit card company, and you end up with a report that summarizes the findings and suggests actions such as recommended additional validation steps. This is some of the stuff that's being developed now, and is being, put into place for audits of big corporations to date. Don't worry too much about it right now. You get into auditing, you'll be seeing much more of this. Okay. Fraud detection is challenging, to say the least. Why? Because the perpetrator is attempting to conceal it. Okay. Now, bank robbery, guy walks into a bank with a gun, says, "Give me all your money," and there's cameras, taking pictures. Fraud, though, is surreptitious by nature. So you have to try and, get it out there into the open somehow. Financial statement fraud is often perpetrated through management override and collusion, makes it even harder to detect. Fraud perpetrators, though, tend to be people who rarely ever stop. Every time they get away with more, it only encourages them, bucks them up to do it again, do it bigger this time. When fraud happens, internal control environment has either been ineffective or circumvented. And again, possibly through collusion or management override. So, and of that, the easiest to pick off really is management override. You can see where the CFO entered something in the journal by himself, or you go and you interview people in the accounting department, and oh yeah, controller came down here and he ordered us to do this and that and the other thing. And sometimes these are just mean people, and staff is more than happy to talk to you about them. Collusion, however, where there's supposedly a separation of duties in place, but the folks who are supposed to be separate are in fact working with each other, that can be very hard to detect. So again, effective fraud detection is an attempt to identify the fraud at its earliest possible stage of detection. Again, it's like a snowball rolling downhill. It'll just keep getting bigger and bigger, because every time the person gets away with it, they're encouraged to do it again. Okay. So the starting point for the anti-fraud professional and forensic accountant is an attitude of, yes, professional skepticism. Burn those two words into your brain. Okay. Recognition that fraud may be present anywhere and everywhere. Okay. I'm sorry, I was involved in an audit of a convent of nuns, and I don't care. I still have to have that professional skepticism that could be fraud going on here. There wasn't, thank goodness. It's exemplified by a professional's attitude that includes a questioning mind and a critical assessment of evidence. Ask professionals to make a commitment to persuasive evidence to determine whether or not fraud is present. Fraud detection techniques require that fraud and forensic accounting professionals pay particular attention to the possibility of concealment. Again, surreptitious by nature. It's going to be concealment. Two major approaches to fraud detection. That's what we're going to talk about now. You detect fraud through identifying red flags, or you detect fraud through a TRA, a targeted risk assessment. So, fraud detection is the first sign or symptom that a fraud has occurred. You can accomplish that through the use of well-designed internal controls, supervision, monitoring, as well as active search for evidence of potential fraud. More work needs to be done to ensure that other explanations, non-nefarious explanations, such as human error, are not at the root of this particular symptom. Okay, so be careful. Don't immediately assume that if some number is wrong or whatever, that was fraudulent. It could just been error. Okay, no evil intent. Initial fraud detection steps are the first of several towards concluding that predication has been met, but are far from providing the evidence that's needed to convince a jury an actual fraud has occurred. So you do these, initial fraud detection steps. If you find that there's some red flags or what have you, okay, now you got your predication. Again, predication is much like probable cause. It doesn't, it doesn't convict, but it allows you to investigate further without having to really worry about getting yourself in legal trouble or like defamation or whatever. Okay, so establish that predication. Okay, predicate, that which comes first. So get that predication, then you can conduct the fraud examination. First thing you have to do, understand the company. Understand the company or the organization and the environment in which it operates. Assess the industry. Okay, are they following or bucking the trends? And really, what kind of industry is it? One there's a lot of, excuse me, open another beverage here. A lot of wild stuff going on. Okay, or is it a pretty, stable, solid industry? Compare your client to competitors. And again, using that horizontal and vertical analysis, evaluate trends within the organization. And what is the environment, if you will, the RIS, with regards to internal control in that organization? Do they have a commitment to integrity, and ethics, okay, and core values? Or, as it was, we heard stories coming out of Enron, where it was basically, dog eat dog. You were told you had to meet these numbers, and if you did, you're out of here. But if you did, they'll pay you well, and they really don't care what you did to get those numbers in there. Turns out that in California, when Enron was a power supplier, to get utilities to pay them at higher rates, they would, say, no, look at that. We're going to have to put you into a brownout situation because there's just, we just can't supply sufficient electricity at the prices you're paying us. So sorry. Well, there was available, but they did that to force an increase of have the utilities pay Enron more, because the folks in the company were told, we don't care how you do it, just get those numbers, and they truly did not care, even if it meant forcing blackouts and brownouts. A commitment to competence. And some of these things, it takes the auditor or the fraud examiner or the forensic accountant outside of the accounting department and into, say, the HR department, the personnel department. Are they hiring well? Or are they just hiring cheap? So they're getting competent people. Do they have an independent board of directors and an audit committee that participates in the internal control process and oversees the process? Are they competent? What is management's attitude, philosophy, and operating style concerning important internal control and operational issues? What is the organizational structure? As I said, I went to that one place and found that the internal auditor was reporting to the president, who turns out was doing bad things. Well, yeah, of course, that's going to be a problem. So what's the organizational structure? What are the lines of responsibility and authority, especially as it relates to control and operational expectations? What about communication, about the importance of control-related matters, about ethics, about anti-fraud awareness and commitment, the organizational and operating plans, employee job descriptions, related policies? Are they talking about it? Are they getting it out there? Are they putting little signs in the coffee room telling people where what the fraud tip hotline is? Or they just don't talk about it? All this goes into that environment. Again, is there a clear and unwavering commitment to a culture of honesty? Do they hire honest employees? And especially if they're sensitive situations. Are they, doing a background check on people? Are they training them in all aspects of their duties and responsibilities? That goes to competency as well. Are they delivering fraud awareness in the organization, in their initial orientation and in ongoing communications? And are they providing fraud risk assessment methodology to the appropriate personnel? Okay, so that's our anti-fraud environment. Let's look for red flags, shall we? Okay. So in the course of your audit or your fraud examination, there was an anomaly. This is odd. I'll come up with one of the amount for uncollectible accounts, assessment of uncollectible accounts, fell dramatically this year than last year. An anomaly. Or the amount of depreciation dropped a lot. Why is that? Or the revenues are way up this year, despite the fact they didn't sell that many more units this year. Why is that? Can they back it up with documents? We hired a new collection agency, and these people are really good. And as a result, we don't have to write off as many uncollectible accounts. Okay. Let's look at the paperwork. Prove it to me. Show me, as they say supposedly in Missouri. What about those documents? Are they falsified, altered, fictitious? Does the transaction and its reflection in the financial statements, do they make sense? Does the transaction make sense in light of the company's operation goals and objectives? Does the totality of this and similar transactions make sense analytically when evaluated in comparison to the economy, to their particular industry, to key competitors, and other related accounting numbers within the organization? Does the transaction have proper approval and the proper authority levels? And is there anything else about the transaction or its nature that makes it appear, as you young people say now, sus? Okay? And does it pass the smell test? Okay? Or is it just something just doesn't seem right there? Right? So what about those tips? Again, tips, the most common detection method. Every organization should have a tip hotline. And again, you will not be punished if you gave a tip in good faith. Work out ways to keep it anonymous. have it being reported at the appropriate high level. As I say, I think it should go to the audit committee or someone working directly for the audit committee. There's a stark variation between small and large organizations regarding fraud detections via tips. 33% of frauds detected by tips in small organizations, but 44% of frauds detected by tips in larger organizations. Okay. There's various explanations that have been set forth for that. More research should be done. Small organization, you might not need a tip hotline. You can go and talk to somebody else. The big ones, you may need to rely on this particular mechanism. Tips and accidental discovery combined account for over 50% of all frauds detected. Okay, there's sometimes dumb luck. You sort of trip across it. Now remember, many times tips and complaints are false. And that's not necessarily, or just do not turn out to be what they were. So, it turns out they weren't really doing that. There was a misperception. Okay, that's okay. You still, the numbers as to successful tips are so good. Keep that tip hotline anyhow. Employees may not report for fear of getting someone in trouble. Again, have that whistleblower fraud hotline. Should be easy. Should be allowed to be anonymous. And if it's anonymous, I would say, give the tipster a code name or a number, so that if they call back later, they can identify themselves as, hey, I'm, tipster number 332, and I want to add to what I reported before, things like that. And that way, also, if 332 calls in later and says, hey, whatever happened to what, that information I gave you, you can tell them. All right? Again, the tipster must provide sufficient detail. It can't just be, I think the CEO is committing fraud. Based on what? And I can't tell. I can't go any further. You really got to need to. Okay. What about those behavioral red flags? Lifestyle symptom, the living outside of means. Again, I would encourage all of you at some point to see the movie All the Queen's Horses that my friend Kelly Pope produced, and about Dixon, Illinois, and the accounting. Again, here's a big old problem with internal control. They decided, let's combine the job of treasurer and controller into one. Yeah, the accountant and the treasurer both doing the same. Yeah, that's bad. And she ripped that town off royally and lived this life of a queen with her show horses. And you would think she would say, oh yeah, well, I have a lot of family money. No, she didn't. She grew up in Dixon. People knew she didn't. They just didn't want to believe it, I guess. So lifestyle symptoms are usually easy to observe. Now, every now and then a smart fraudster will essentially live a double life. And we've seen this in any number of cases. There was a case in near New York City where a Catholic priest was ripping off the parish and would then take days off. Or I guess he's only working weekends, but would not really, but had a second lifestyle going on in New York City, where he had an apartment and was, had going on dates and things like this. Okay, had this second life. So, eventually it came tumbling down. But very often they don't take the effort to keep the two separated. Most perpetrators spend their ill-gotten gains almost immediately. Yeah. One thing we know about fraudsters is they don't invest the money, they spend it. And recovery is usually very, very low. And just about their behaviors, especially if there's a change in their behavior. Now, changes in behavior can come because of trauma. A spouse dies or a child dies, things like that. But otherwise, if you see a change, what's going on? Remember, fear causes the fraudster to act differently. Stress will change a fraudster's behavior. Difficult to discover fraud from these clues alone. That's not enough. But when combined with other, red flags or other situations or other anomalies, now you've got a red flag. Okay. I remember one firm, they had a guy who would come in, go into his office. His office had like big windows all around it, and he took like butcher paper and covered up the windows so people couldn't see him inside there. Well, that's a kind of an odd behavior, and I might want to look into that. But on the other hand, turns out just the way he was. So hang on a second, I just got something here. Okay, we're back. One of the great things looking at now is the analytical anomalies, and our data analysis is getting so good. And with AI, AI can be your friend. Okay, it doesn't have to be. We got a lot of bad actors out there with AI who are doing bad things with it, with deep fakes and all the rest, but it can do really good work as well. So, you can ask AI and ask, data analysis to look at a huge amount of data and say, where are some transactions or financial statement relationships that just don't make sense? Transactions that are too small or too large when compared to normal activity. What are some patterns? Where are there breaks in the patterns? And then, analytical anomalies are common and should be pursued until fraud is either discovered or ruled out. Again, whether it's an anomaly or a red flag of some type, it doesn't mean necessarily fraud has occurred. It simply means you got to look into it a little bit more. Okay. So here are some anomalies. This is a great slide to keep, and print out. Unusual items, missing items, larger or smaller than usual items. No pattern when you'd expect one. A break in the pattern that's unexpected. Transaction amounts that are round. Usually that doesn't happen. Cash transactions instead of by check or wire transfer. Large consistent transactions, unusual timing of transactions, unexpected transaction recipients or beneficiaries, unexplained cash shortages, unexplained inventory shortages, deviations from specifications, increase in scrap, excessive purchases, and just too many debit or credit memos. Okay, that's just scratching the surface, but those are pretty good ones to start with. Again, anomalies may include, we talk about, have your data analytic package or your AI to look for these strange relationships. Okay, revenue is going up, inventory is decreasing. Well, it would decrease a little bit. You're selling the stuff, but you would be replacing it, you think. But accounts receivable are decreasing. So you're selling stuff, but nobody's buying it on credit. Huh? Accounts receivable increasing, but at a greater percentage. Inventory is increasing, but accounts payable are decreasing. Inventory is increasing, but decreasing warehouse costs. Where are you keeping this stuff? Right? You have an in volume, but increased cost per unit, but decreased scrap. Okay, we expect there to be economies of scale. So if there's increase in volume, we expect a lower cost per unit, right? All right. Some more on accounting anomalies. Or more on anomalies, in this case, accounting anomalies, okay? Unusual activities that seem to violate normal expectations for the accounting system. Irregular or undocumented journal entry. So, hey, there's a journal entry in here, and there's no explanation for it. Or there's an explanation, but it doesn't reference any documents you can tie it back to. Entries that reduce liability while simultaneously increasing a revenue account. Whoa. Reduce a liability, increases a revenue account? That seems odd, right? Unusual or problematic entries should be closely scrutinized. And this, when this goes on, that's what we call cooking the books. Again, you should have watched the 4-part videos on Farmore. You know, there's the guy in there talking about cooking the books. Right? Some more accounting anomalies. You know, wait a second. This last slide was 1 of 2, and this one is 1 of 2. Okay, I gotta have to write my friends and say that should be 2 of 2. Again, missing documents, old items being carried on bank and other account reconciliation. Okay, deposit in transit should not be on more than one, bank reconciliation. Excessive voids or credit memos. I mean, you're going to have those now and then. If you got more than that, what's going on? You have common names, addresses, or phone numbers of payees or customers. Okay. Not just common names like, to some extent, if you have a bunch of customers who are all named John Smith, that's unusual. But if you have a whole bunch of customers with the exact same name, exact same address, exact same phone number, that's odd. Names, addresses, or phone numbers that are the same as those of your employees. And again, you can have your, any number of data analytics packages that can, kick that out in, 2 seconds. Increases in past due accounts receivable, excessive write-offs of accounts receivable, because maybe they were fictitious to begin with. Okay, here comes our 2 of 2. Increases the number and amounts of reconciling items, alterations on documents. Why did you white out some numbers and write over it on here? Duplicate payments, second endorsements on checks, which is hard to find. Again, banks aren't returning checks anymore, and generally they only show you the front of the check. Breaks, but if you inquire, they will send you the back image as well. Breaks in check, invoice, purchase order, and other document number sequences. Yeah. Why did we go from check, 1500 to check 2300? Questionable handwriting. Be careful with that. Handwriting analysis is a bit of a skill, but if all the handwriting and written checks are made by the same person and suddenly the different handwritings in there, that could be used. Photocopy documents rather than the original document. So they give some examples of anomalies. Here's some journal entry examples. We got cash going out to buy a fixed asset. Okay, $350,000. But the same $350,000, account receivable and sales. Okay. And now we got the collection at $350,000 and cash and accounts receivable. Now let's put them all together. And so we see is that we have a debit to cash and a credit to cash, both for $350,000. We've got a debit to accounts receivable and a credit for accounts receivable, both for $350,000. And if we eliminate those, what we see is fixed asset, debit, and sales, debit, $350,000. That seems to be an odd combination. you made a sale and you got a fixed asset for it. So they had this anomalous transaction that they kind of try to cover it up by turning it into 3 transactions. In years gone by, this is our second 2 of 2. In years gone by, it was possible for the general ledger not to balance. But now that we, with most computerized accounting packages, prevents one-sided and unbalanced journal entries from being recorded. Professional skepticism requires the fraud examiner to test the assumption for veracity. Unbalanced entries are a real possibility in manual accounting systems and those maintained in spreadsheet software. It's common that payroll systems, marketing systems, inventory records, and accounts receivable details are independent of the main accounting system. All right. Internal control irregularities and weaknesses. Again, internal controls should be used to prevent, deter, and detect fraud. In a normal internal control environment, you've got adequate separation of duties. Again, very difficult in small businesses. You just don't have enough personnel. But if it's big enough, there should be adequate separation of duties. And in small businesses, when you don't have that, in most cases, they're small businesses that are owned by somebody. There's an owner. Well, then the owner is going to have to step up and do some additional work, like the bank statement reconciliation. Okay, bank reconciliations, like reviewing payroll and doing some work. It's after all, it's their business. Proper authorization of transactions and activities, adequate documents and records, physical control over assets and records, and then independent checks on employee performance. Common accounting information modules. Okay, so you've got your sales and accounts receivable collections. You've got personnel and payroll. You have procurement, acquisitions, accounts payable and disbursements, inventory, warehousing and distribution, capital acquisition, maintenance, retention, including depreciation, and disposition, cash accounting and control. So, usually these are all kind of, lumped in these groups. All right. Fraud prevention refers to creating and maintaining an environment in which fraudulent activity are improbable, reduced to at least an acceptable level of risk. Fraud deterrence involves creating an environment in which fraud is less likely to occur, say, through, this is usually accomplished through a variety of efforts associated with internal controls and ethics programs. Okay. Again, prevention is, you've got those controls and such in place that does not, it makes the perpetration of fraud almost impossible. Deterrence is, as I say, you're messing with people's heads. Okay. You create an environment in which fraud is less likely to occur, in big part because it will be detected and they will get caught and they will be punished. Okay. Fraud detection is the process of discovering the presence or existence of fraud. And internal controls also need to be focused on fraud detection. So internal control involved all 3 of those concepts. Typical weaknesses. And we've already talked about that first one a lot. Lack of the segregation of duties or improper segregation. Segregation of duties where, okay, you who work on this side of the desk do this, and you who work on the other side of the desk do something else. Well, they're a little too close. Lack of physical safeguards. Okay. My favorite was the company that used a lot of platinum, and they kept these platinum ingots in an outdoor steel shed that, being outdoors, was rusting, and you could literally stick your arm through one of the holes of rust and grab an ingot of platinum, which some of you may know is quite valuable. A lack of independent checks. If nobody's checking on you, what the heck? Again, it may not be fraud, it could just be, human tendency to try to cut corners. But there should be independent checks. You don't check your own tests, right? At least I don't let you. Lack of proper authorization, lack of proper documentation and other records. Okay. Override of existing internal controls, inadequate accounting systems, inadequate employee education, okay, and expectations from your employees as well. The reactive fraud detection approach. Well, we'll wait until we have a fraud, then we'll go, look to see where it came from. We don't want to do a education on fraud or do a fraud audit because we don't need it. We haven't found any fraud, and only give people ideas. That's one of the biggest on that. We only give people ideas. Inadequate surprise audits. Oh, everyone loves a surprise audit. No, they don't. But they're, especially for things like cash, which can walk away. And also inventory. Inadequate whistleblower opportunities and protections. Yes, get that tip hotline and make it clear that you will be protected if you do so in good faith. The power of non-financial numbers, and they're powerful. One of the reasons because very often the fraudster who's trying to manipulate financial records and accounting records sometimes doesn't think about the non-financial numbers, okay? But you should. So let's use data from the surrounding operational systems. How much raw materials did they buy? How much labor was used? How many items were produced? Does it make sense? Okay, how many hours was the factory line working this quarter? How many hours was it shut down? Did the company shut down for 2 weeks in the summer, and yet the numbers didn't show the shutdown? So the world revolves around quantities and prices. Break sums down to quantity and prices, then correlate with numbers represented in financial statements and tax returns. Again, start with data generated outside of the accounting system. Again, red flags do not indicate fraud, but they indicate further investigation is necessary. So each fraud has unique attributes. Okay, consider a red flag in the context of the circumstance. What causes transactions to seem unusual or irregular? Use evidence to develop other reasons for the suspicious activity. Consider possible motivations of who might be involved. And this is our standard approach, right? We get that red flag. Okay, we create a hypothesis. Why is it like this? Well, it might be XYZ. Look for evidence. Let's say it's X. Look for evidence that it was X. What evidence did you find? Did it instead hint that it might be Y? Okay, change your investigation to look for explanation Y. And maybe, maybe it'll show that everything is cool. But, okay, develop reasons for that suspicious activity. And be willing to modify your hypothesis in accordance to what you find. The elements of fraud. Okay. Are cash or other assets missing? Has a fraud act or financial crime possibly been committed? So, you get a call, as, I have in the past. Hey, we got a problem. We're supposed to have had this much more money in our petty cash, usually that's not a big problem, usually in their vault, and it's not there. Okay. Are the financial statements materially misstated? What are the concealment possibilities? What are the conversion possibilities? And have any conversion symptoms, again, such as those lifestyle anomalies, been observed? So there's cash missing, and our new employee keeps flying off to the Caribbean every weekend. Yeah, that could be a problem. Remember our fraud triangle. right? So which individuals have the opportunity to commit the fraud? So if they don't have the opportunity to commit the fraud, don't worry about them, at least not right away. So what are the key internal controls in the area? Are those controls deficient? Have they been violated? Have they been, overruled? Have any individuals demonstrated signs of pressure? Remember, opportunity, pressure, and the other one, what potential rationalizations might be offered, and is there any evidence of rationalization by particular individuals? They were passed over for a promotion. They didn't get a bonus that they felt they deserved. The boss is just on their case constantly because you got a bad boss, okay? And this was their way of getting back at them. Other considerations. What are your most promising investigative techniques? What methods and approaches will most likely result in a successful investigation? Have any other related symptoms been observed? And how do the red flags that have been observed in one area relate to red flags observed elsewhere? And they could be completely independent, or there might be a relation between those. All right, so there's our red flags. We look for the red flags, we find them, we use data analytics, we find them, and then we investigate further. And we conduct a targeted fraud risk assessment. Okay. We got a bunch of steps here. Okay. Number one, ask yourself, do one or two key employees appear to dominate the company? Ooh, small companies, that can especially happen. But it can happen in big companies too. Do any key employees appear to have a close association with vendors? Do any key employees have outside business interests that might conflict with their job duties? Does the organization conduct pre-employment background checks to identify previously dishonest or unethical behavior? Especially for jobs that are sensitive, right? Does the organization educate employees about the importance of ethics, and do they have an anti-fraud program? Does the organization provide an anonymous way to report suspected violations of ethics and anti-fraud policies? Is job or assignment rotation mandatory for employees who handle cash receipts and accounting duties? Okay. Because I'll tell you, some of our biggest frauds out there that have taken place in the accounting department is because that's so-and-so, he's been our, payroll accountant for the last, 40 years. He does a great job. Yeah. Not cool. Okay. Not cool because nobody's ever covered him, or, it hasn't been rotated out. He was pulling he had, ghost payrollers on the payroll. Has the company established positive pay controls with its bank by supplying the bank with a daily list of checks issued and authorized for payment? This is increasingly becoming a service that banks will provide. Okay, not every bank will provide that. Increasingly they are. Are refunds, voids, and discounts evaluated on a routine basis to identify patterns of activity among employees, departments, shifts, or merchandise? Okay, very important that you do that. You don't have to do it. Well, I should say, I was going to say you don't have to do it, constantly, but now we have software and apps that will do that. But at least periodically and on a surprise basis, take a look at those refunds, voids, and discounts. Now, is it one employee who's handling more refunds than anyone else by far? Okay. Is there certain merchandise that keeps getting returned? Well, you might have bad merchandise, or somebody's figured out a way of manipulating the system with a particular product. Are purchasing and receiving functions separate from invoice processing, accounts payable, and general ledger functions? Okay. Again, in any sort of acquisition, it's the purchasing function, the purchase order, the receiving function, the receiving report, and then the invoice and payment of that invoice. So keep those things all separate. Is employee payroll list periodically viewed for duplicate or missing Social Security numbers? I mean, that's something, again, we have beautiful apps that will do that on each payday if you want. Are there policies and procedures addressing the identification, classification, and handling of proprietary information? Okay, yes. Company secrets set you apart from other companies. And that's where the industrial espionage comes in. Do employees who have access to proprietary information sign a non-disclosure agreement so that if you find that they are trying to sell that proprietary information to your competitors, you can immediately fire them, okay, and possibly sue them for damages, including liquidated damages, where that non-disclosure agreement, known as an NDA, says, hey, if you do that, we can, you're sort of admitting, and that damages would be, no less than $100,000, whatever. Is there a company policy that addresses the receipt of gifts, discounts, and services offered by a supplier or a customer? And may I add, I think I've mentioned this before, is there a reasonable company policy? Again, around the end of the year and the holidays and stuff, people, customers, suppliers will, sometimes give gifts. All right, fine. Just as long as it's not, a new car, right? Make it reasonable. And are the organization's financial goals and objectives, are they realistic? Because when they're not, you're just setting yourself up, and you've given that fraudster their rationalization, that side of the fraud triangle. All right. Overarching questions for, or during a targeted fraud risk assessment. What's the likelihood of fraud occurring in this organization without consideration of controls? What types of frauds would likely occur in this organization? What types of frauds are likely to occur without consideration of the controls? These are also great questions during that pre-audit brainstorming session about fraud with your audit team, okay? What types of fraud might be successful? How large could that fraud be? Would the fraud be large enough to generate the financial impact that allows the fraudster to achieve his or her goals? By what process could the fraud be perpetrated without consideration of controls? How strong is the anti-fraud control environment? How well do the control systems appear to be working in the area where the fraud would be perpetrated? Again, those are great questions during a brainstorming session. So let's categorize possible fraud schemes, okay? Category 1, wrongdoing perpetrated by an insider acting alone with the principal benefit to the individual. Okay, that probably most frauds, I would say. But then category 2, wrongdoing perpetrated by more than one individual acting collusively with the principal benefit to the individual perpetrators or the organization. Manipulating financial statements to make the organization look better. So they're not, well, you can do a combine. If they're also getting stock options, it's both. But they want the organization look better. But usually it's for the individual perpetrators. And again, when there's collusion, usually the median amount of the fraud goes way up. Category 3, wrongdoing perpetrated by an outside third party against the organization with the principal benefits to that outside third party. Okay, let's look at revenues. How would a person perpetrate an over or understatement of revenue? Who would be involved? Would it be collusive between customers and sales and marketing? Which accounts would be affected? When would the scheme be perpetrated? Which quarter of the year is most at risk? And which financial statement assertions are at risk? Overview of the process. Evaluate the fraud risk factors. Identify possible fraud schemes and scenarios. Prioritize individual fraud risks. Evaluate mitigating controls for those fraud schemes that are reasonably possible or probable and are more than inconsequential or are material. And here is our 10-step approach to a targeted fraud risk assessment. Okay, so you decide, let's do a targeted fraud risk assessment. What do? Number one, identify, understand, evaluate the company's operating environment and the pressures that exist. Understand the company that you're looking at. What do they do? What's the industry they're in? What are the pressures that exist? Are they an industry, for example, right now, that's dependent on petroleum? Have you seen the price of gas lately? There's some pressures. Can they handle it? What about an airline? Okay. Last time we had a big hike in the price of fuel, petroleum. Some airlines did okay because they had already had big contracts and had big storage, for jet fuel. Others, not so much. Identify the business processes and consider differences in those processes in foreign operations, as well as between subsidiaries and in decentralized divisions. Identify the process owner for each of the identified significant processes. Okay, so we've identified the various business processes. Again, step 2, consider the differences with foreign operations and at distance and decentralized divisions. 3, who's the owner? Who's the champion, if you will, of each of those processes? Review past fraud experience within the company for the process that you are evaluating. Identify how fraud may occur in each process and at each location using fraud brainstorming techniques. Okay, we mentioned that. Identify the parties who have the ability to commit the potential fraud. Evaluate the likelihood that each of the identified frauds could occur and be significant, as well as the persuasiveness of the potential fraud without consideration of controls. Okay, so don't think about what controls we have in place. Don't think about those. What would be, how big would this fraud be? Consider the likely methodology to commit and conceal the fraud to determine the level of mitigation to prevent, detect, and deter the fraud. The result is a determination of the existence of what we call the residual fraud risk. Investigate the characteristics of potential fraud manifestations within each process that's been identified in which residual fraud risk exists, and then remediate fraud risk schemes by designing control activities, or should be redesign control activities, so as to mitigate the unmitigated fraud scheme risk. So if you've got a situation where you've determined that this one particular person handles all of these functions, let's mitigate that risk by dividing up their job. Okay, segregating those processes or separating those processes. Module 4, okay, doing this in our digital environment. Okay, that's to say, IT, right? So here we got our AI coming in, is influencing fraud detection, banking chatbots, and algorithmic trading. Electronic environment captures millions of transactions annually. Actually, probably trillions or more. Targeted risk assessment process yields the highest probability of frauds. So we have out there some called CATs, computer-aided auditing tools and techniques to prevent and deter fraud. Okay, and they're beautiful. They just sort of, let the cat loose, and it goes through all of those wonderful databases of information, and you have to guide it, but comes back fairly quickly with the data extraction first, and then analyzes that and gives you a report. So what about digital evidence, as opposed to paper evidence, right? Information is captured electronically, available to monitor the fraudster's activities. Electronic storage is now relatively inexpensive. In the past, not so much. In fact, even the use of computers used to be quite expensive when they first started using. When I was back in my auditing days, if you wanted to use computer, you wanted to use CAT, because use of computers were so expensive. There was big mainframe computers. There was one place we go, it was at Detroit, at Deloitte. We would go to this place with our data to be analyzed, sometimes on big reels, and we'd go in the middle of the night because they would charge less if you went in the middle of the night than if you did it during the day. So, show up at 1 in the morning, downtown Chicago, run the data until 5 in the morning, and then head home. Shower, change, and get into the office by night. So fraudster risks detection during the fraud act, and as long as the data is out there. Okay, so stored data can be used to trace transactions, document approvals and exceptions, and provide evidence of a system override. Again, the value of information systems, they can generate red flags for further investigation. They can reconstruct the actual data flow. They can provide a strong evidence trail. However, it has potential for overwhelming the number of fraud symptoms. It can come back with 1,000 red flags. Well, that's kind of a lot. Maybe we don't need to worry about so many. So there's a potential, if you don't design your particular application correctly. Targeted approach must have sense of what could or did go wrong, and how might it manifest itself within the IT, or the information system. And there's our little thing there. All right.